Welcome, welcome, welcome to Wealth Strategies Unleashed. I'm Robert Gilliland
And I'm Mike Alexander
with Concenture Wealth Management. Thank you for joining us for this week's podcast. You know, Mike, I was sitting here kind of thinking about some topics for us to go through to kind of chat about. And it seems to me with everything going on in the world and everything that we've got going, it almost kind of feels like we're moving from crisis to crisis to crisis, right at a time when people are thinking about retirement, maybe in retirement, a couple of years from retirement. You know, and I thought it maybe made sense for us to maybe have a conversation about what people can do to, to kind of crisis proof their retirement or their retirement plan.
Well, so, obviously a very, very timely subject. I think what we always like to talk about, Robert, is that markets tend to climb a wall of worry. And this one seems like we're adding another brick every single day. And, interestingly enough, the marketplace that we've been in has been one that has been very, very condensed, if you will, down into just a handful of names. I think, many people, hear a lot about the Magnificent Seven and, these seven stocks that tend to be more AI related, leading the way, and a diversified portfolio has really had a hard time, keeping up in that environment. We're seeing a little bit of a reversal of that in the last couple of weeks. And obviously some of that has to do with, the geopolitical risk that we're seeing out in the marketplace. And perhaps some of it has to do with, valuations and concerns about whether or not, we're going to have a recession. And if so, is it a hard or soft landing? And what's the Fed's posture? Government shutdowns, chaos in Washington. It's just a number of things that I think really tend to be worrying a lot of investors out there.
I think you're exactly right. There are a lot of things, and sometimes when you're right in the middle of it, it seems like you're never going to end, like a rainstorm, right? You're driving and it's raining, and you think that it's raining everywhere, and it's not until you get on the other side that you realize, hey, the sun. Or when it's cloudy and you get on an airplane, you go and you take off, you think it's cloudy everywhere, and then get above the clouds, and hey, there's sunshine. Right. And I think that when you're looking at retirement, specifically in this market, I think your point's really, really valid. You got the Magnificent Seven, and then you have the 493, right? They've done nothing. And this crisis period that we're kind of going through, the reality is that we're not seeing defensive stocks. We're not seeing them go through and benefit. But, if you are worried that there's going to be a recession, you are worried that we're going to continue to have this increased volatility, let's talk about a couple things. And I'll start. One of the things that I think you have to do is you have to maintain this long-term growth, this long-term perspective, right? You have a portion of your assets that are long-term, and everyone's heard these stories, but just some recent statistics, easy for me to say, right? Some recent statistics that we just kind of pulled up. If you go back and you look over the last 25 years, if you missed the 50 best trading days of the last 25 years, you ended up with a negative 2.24% return on the S&P 500. If you were invested that entire time, you had a 7.91% return. So maintaining a portion of your assets that are long-term, that are those investments that are tried and true, those good, solid S&P 500 type of companies, you're going to be okay in the long term. See, it's only when you're in this short term mindset does the volatility really go and make you make bad decisions.
You're 100% right. Robert, the reality is, you mentioned the Magnificent Seven. I think as of mid-October or so, on average, those seven stocks were up about 80% on a year-to-date basis. That's just an incredible number. But if you factor in the broader marketplace, it was down about 2%. So just if you were equal weighting, the stocks in the index. And I think that just highlights that, from time to time, you get in these environments where there's a tremendous amount of euphoria over a handful of names. I think the environment that we're heading into, and this is just part of, proofing your portfolio, if you will, by maintaining a level of diversification and thinking about the long term, is that we may be entering an environment where the index itself, as measured by, for example, the S&P 500, may not advance that much because you have too many stocks that haven't been participating. But once that market tends to broaden out, you start to see, these other names start to participate. So you may not get, quite the move out of the index because it's a market cap weighted index, but you might get a little bit better performance underneath the hood, if you will, as some of the other names start to perform better. So, I think we tend to believe that diversification does tend to win out over the long run, and that this is a time for people to be, making sure they are diversified across their portfolios.
I think that when you're talking about how do we crisis proof, though I don't profess to be any sort of expert when it comes to behavioral finance or behavior in general. My wife would say I can't even understand my own behavior. When you're looking at the thing is that behavioral finance looks at what your relationship is to money and what causes you to go through to make certain decisions. When people are looking at times of crisis, we'll call that a lot of volatility in the market. What ends up happening is that they end up making the wrong decisions at the wrong time, right? And I think there are some really concrete things that you can do when you're looking at volatility and what's happening inside of the markets that really can make a big difference. One of them is that if you're uncomfortable with the amount of risk that you're taking in the portfolio and worried that the market's going to drop and then all of a sudden you're going to be in dire straits, well, it probably makes a lot of sense to go ahead and take some chips off the table, to go ahead and create some cash until you feel better about where the market is. Having cash, because especially in and prior to retirement, making sure that you have cash flow so that you can weather the volatility makes all the difference in the world when it comes to success.
Yeah, absolutely. I don't think anyone wants to be a forced seller in any kind of environment. So making sure that you have adequate, cash, just to meet needs that are likely to arise over the short to intermediate term allows you to kind of ride out some of the rougher periods of time. We're in an environment where, it's October the 30th and just over the last, couple of weeks, we've seen a fairly significant decline in some individual assets, but the broader indices have corrected about 10%. That's not uncommon. We see that even in the best of environments where, stocks can get overbought and oversold. We just happen to be in an environment where, some of the big names that we've talked about previously have finally begun to correct a little bit and really catch up with some of the other parts of the market. I don't think it's lost on many investors that interest rates have risen significantly, and that's created a lot of value in the bond market. And so this idea of one, having ample amounts of cash should you need that makes a lot of sense, but also just making sure that that you're going back and re-examining your portfolio to make sure that it's balanced on a go forward basis, because I think there's really good opportunities again outside of some of those those big tech growth names, but also in the fixed income marketplace as well. So being balanced and diversified is going to make a lot of sense.
When do you redeploy it? And how do you redeploy it? And I think that in times of crisis, so if we go back and think of the most kind of recent crisis, you have COVID and the March of 2020, right? March, April timeframe there. You go back and you look at the Great Recession, 08, 09. You go back and you look at 2000, 2001 kind of timeframe. If you had cash, the way that you could turn around and redeploy that, and the smart thing to do would be to dollar cost average in. So today, to crisis proof your retirement, if you are sitting in a lot of cash, and we have a lot of indications that people are sitting on more cash today than what they were, call it 5 years ago, right? One of the things, and you're like, I think the market's high, but I don't know. And we've had this volatility. It might make sense to set up a dollar cost averaging strategy, right? So if you're worried that the markets are going to drop and you need money for cash flow, keeping money safe and on the side is one thing. But if you have money sitting in cash, you think the markets are going to drop, you just don't know when. Dollar cost averaging turns around and makes sense inside of that, because if the market is down, then what you're doing is you're buying things on sale. Now, that doesn't mean you just throw money at the market and buy the same old names. Diversification becomes key inside of that. Mike, kind of when you go through and you think about kind of recession crisis proofing your retirement, is there anything else, any other sort of kind of ideas, that things that people that maybe aren't hearing about, aren't thinking about, that maybe they should, that kind of come top of mind?
Well, I really don't think that I don't think investors are hearing a lot about diversifying a portfolio. It's one of those, kind of concepts that seems to have gone away. We've had periods like this. We've had the Nifty 50 periods. We've had, the tech bubble in the late 1990s. We've had a scenario like the one that we're in, where just a handful of stocks are really driving index performance, and a lot of names are not really participating in that. And so it's really a situation where you have the index kind of masking underperformance in a lot of areas. And I think it's a good time to go back and look at some of those things, and look at some of those areas of the marketplace that really investors have ignored, but maybe the fundamentals make good sense. You don't hear a lot of people talking about international or emerging markets, or many parts of the marketplace. Certainly, we've been in an environment where people didn't want to own fixed income at all because interest rates were rising, and so I think, as you mentioned earlier, Robert, there's this amount of cash that's on the sideline. I think serves as a pretty good buffer, and kind of puts a floor underneath markets. There's about $6 trillion worth of cash that's sitting on the sidelines, and I think that bodes well for performance going forward. I realize that there's, the market's a bit like a yo-yo, and there's a lot of people that are on both sides of that, and so. That's usually when opportunity, presents itself. So I think your thoughts around dollar cost averaging make a lot of sense. We're heading into what is typically, the seasonal period of outperformance, which is kind of in that post-October through the holiday period and into the first part of 2024. And so certainly, I think makes a lot of sense to make sure that you're looking at that closely.
And so I think, to kind of, when you're going through and thinking about how do I crisis proof my retirement, I think that kind of some of the things that we've kind of talked about here. Number one is that make sure you're reviewing your plan, right? You understand where you are. Make sure that you're diversified. If you're fearful that the markets are high, and you're just really uncomfortable, that may mean increasing your cash position. If you are sitting on a large cash position, it may make sense that when you do have these periods of volatility, that you do go and think about a process for dollar cost averaging. When you're thinking about crisis proofing your portfolio, being aware that but behavioral finance forces, in other words, your relationship to money. In other words, another way to say that is that greed at times is a more powerful force than fear. And the fear of missing out on the next run is motivating to people, which may make them take unnecessary risks. And so making sure that you're evaluating the risk that you're taking inside of the portfolio, looking at some of those out of favor asset classes, making sure that your plan's in place and that you have cash flow to weather the storm. Because it's not a matter of if we're going into a recession. It's a matter of when. It's inevitable that we will go into another recession. And kind of with that, Mike, any final thoughts?
No, I think your points are spot on. Again, I just think being balanced, being diversified, and kind of recognizing where you are relative to your broader plan really makes a lot of sense. So thank you.
Well, I hope everyone had a great time and understood and got a couple bits of information here to make you maybe think about what should you be doing to make sure that this next crisis, and Lord knows we have a lot of different possibilities out there, whether it be geopolitical, whether it just be dealing with a government shutdown or some sort of bubble or something like that popping, making sure that you're protected. Hopefully you found some good advice, and we will definitely see you next week.